From New York City for our viewers worldwide, I'm Matt Miller. Bloomberg Real Yield starts right now. Coming up, the Federal Reserve cuts rates for its third consecutive time this year, despite growing dissent, while committing to purchase $40 billion of Treasury bills per month starting today to ease short-term funding costs. And Oracle's credit risk surges to a fresh 16-year high as AI spending fatigue hits the markets. We begin, though, with the big issue, the next steps for a divided Fed.
I was hoping for a Fed that was more divided.
There could have been a lot more dissent in favor of no rate cuts.
The changing nature of the debate within the Fed itself is telling us there's going to be uncertainty.
Powell came out and really justified why there was yet another rate cut.
They really want to tell us that the base case is a hold for January.
The pause is in.
There's pretty good consensus that if they're going to move further from here, you either need to see a weakening in labor or a improvement in inflation.
There's certainly a risk here that you could see inflation that's a bit more sticky.
I think the Fed is well aware of the fact that inflation remains a very sizable problem.
If the labor market is clearly weak, the Fed's cutting a lot more than what's priced in.
So this concern that the Fed has about the weakness in the labor market, I think it's a bit overdone.
There's a risk that this data comes in much weaker than we're expecting.
The sort of volatility we get in economic surprises keeps us in this scenario.
And we don't just have divergence on takes, we have divergence in rates as well. Take a look at the 10-year yield here in blue versus the Fed funds rate in white. Since this cutting cycle began and we've come down 125 basis points on the front end, we've seen the 10-year yield actually rise to right now 418, 419. Take a look at the dots function as well, because the markets are predicting a different path than we see from the dot plot. Here in blue is Fed funds futures, and you can see we come down to between 3 and 3 1/4. Meanwhile, the dot plot doesn't get down to 3 1/4 until 2027. So there's a little bit of tension there. Tension in the Fed's dual mandate only hardening, growing dissents at the central bank, leaving Fed Chair Jay Powell caught in a balancing act.
There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once.
Let's dig into all of this with our roundtable. With us today is Mike Contopoulos, the Deputy CIO at Richard Bernstein Advisors, and Alexander Wolf, the Global Head of Macro and Fixed Income Strategy at JPMorgan Private Bank. I'd love to start with your take on what we heard from Powell and the Fed yesterday. Alex, I'll start with you. What did you think?
So I think they were pretty clear that for a further cut, we need to see weakness in the labor market. They will respond to weakness in the labor market, and they've signaled somewhat of an extended pause. They are facing a difficult balancing act, as we heard from a number of guests on the show, where inflation is still sitting above their target, as everyone widely knows, but we've also seen weakening in the labor market. It's not clear exactly, is that going to weaken further, or will we see it rebound next year? We think it will rebound. At the same time, this is what makes it complicated, is that a lot of the inflation that we're seeing is really tariff-induced, tariff-driven. So that should fade into next year. Even the St. Louis Fed showed that tariffs are probably contributing about 0.5 percentage points to inflation right now. So you could actually see both at the same time, where the labor market improves slightly, but inflation comes down, still allowing for more cuts. We do still expect one more cut next year. Timing is less certain, though. It'll depend how data shapes up.
So only one more cut, but you think the labor market can improve while inflation comes down. That's good news. Mike, what do you think?
I think there's some truth to everything Alex just said. But at the end of the day, I'm not really certain as to why the Fed is cutting to begin with. You had over 17% year-on-year earnings growth in Q3. You have inflation that is 3% and bottomed in April. You have jobless claims that are very, very healthy. Maybe you can make the argument that the labor market is weakening, but it certainly isn't weak. But I think what many forget is what is the purpose of monetary policy? Like, why cut or raise interest rates anyway? Is to affect the lending channels, and yet spreads are at all-time narrow levels, and you have no problem getting credit anywhere in the country. And so I'm not really sure what the logic is to cutting here. I think if Alex is right and employment ends up being stronger in 2026, and the Fed, with this latest cut and maybe one more next year, you likely see higher inflation, not low inflation, as growth would reaccelerate. So I think the market's reaction has been very rational. It's very similar to what we saw last year when the Fed cut interest rates. You're cutting rates, you're juicing inflation, you're juicing growth, steeper yield curve, and higher long-end yields, and that's what we're seeing.
Mike, what do you expect as far as rate cuts in 26? Because Alex expects only one, and I know that you think we could see inflation rise. So normally I would take away from that the possibility of one or no rate cuts, but President Trump is putting in his yesest yes man as the chair of the Fed, and there's talk about trying to potentially get rid of the regional Fed presidents and replace them as well. So isn't this Fed going to be one that wants to cut regardless of what we see in the data?
I don't worry too much about that, Matt, because at the end of the day, I think the markets will do the Fed's job. If you cut interest rates at a time when inflation's going higher and growth is accelerating, rates aren't going to go down. They're going to achieve the exact opposite of what the administration wants, which is lower interest rates in the long end, lower mortgage rates to juice housing, et cetera. And so I don't worry too much about what's happening within Fed leadership, because I think the market will punish them if they make a mistake. With that said, I think it's highly improbable that this Fed is going to all of a sudden defer to whoever the Fed chair is without putting up a fight. And at the end of the day, the Fed chair's job is to represent the committee, not his own views. And so it's not something that that concerns me too much.
All right, well, we did get the Federal Reserve Board of Governors unanimously reappointing 11 of the central bank's regional presidents to new 5-year terms. Nonetheless, Scott Bessent has said he wants these governors or these Fed presidents to live in their districts for 3 years, which a lot of them don't. It does seem like this administration wants to take control of the Federal Reserve. Does it bother you at all, Alex?
We definitely see it as a risk. It's a concern if we were to see a loss of Fed independence, certainly, because you would see longer dated yields rise, and that is a key part of the policymaking institution is Federal Reserve independence. We're not, similar to Mike, we're not that concerned. I think the governors that have been reappointed is a good sign. And as Mike said, replacing Powell is just one seat, and that's unlikely to have a broad influence over the overall committee. It's just one voting member. And we're generally still viewing the Fed as one that can independently pursue its mandate. And it's also not new. We've seen administrations through modern history want to exercise more control over the Fed, and throughout that, if you go back to Nixon, even throughout that, the Fed has been able to independently set monetary policy. And so, yes, it's definitely a risk, I think, to keep an eye on, but we're not that concerned about it getting much worse.
Fixed income has had a great year. Where do you put the incremental dollar, though? When your client wants to invest more money, what are you buying right now?
Within fixed income or overall?
Well, within fixed income.
Within fixed income, so we still like higher grade credit. So we still like investment grade. We've seen spreads tighten across the board. We think they've tightened probably a bit too much in high yield. In investment grade, they've certainly tightened, but we're still okay with the all-in yield. We're broadly still okay with just earning carry. We don't see spreads tightening much further, but we think the all-in yield is okay. We also like corporate hybrids. It's a much bigger market in Europe, more deeper, more liquid, more issuers. We see that market growing in the U.S. And so you're getting extended credit-like returns from investment-grade issuers, and you're just moving out the capital structure instead of moving out the risk structure. So we have been more focused going into next year on hybrids as well.
Mike, what do you do with new money right now? Where do you put it in fixed income?
Well, it wouldn't be a fun show if I only agreed with Alex. So I would take the exact opposite view on investment grade corporate credit. From my perspective, I'm not sure what the upside to owning credit risk is here. When you can own, munis or agency mortgage-backed securities with similar, if not better, yield with a government guarantee, with the backing of tax receipts, and more spread tightening potential relative to historic lows in mortgages, say, than investment grade corporates. So, the path to hell is paved with carry. Don't like carry trades. And so for us, it's mortgages and munis here.
Mike, great having you with us. Thanks so much for joining us. Mike Contopoulos of Richard Bernstein Advisors. And Alex, just before I let you go, you intrigued me with that. Where would you put money overall or just fixed income? Do you have other ideas that you like better?
Well, if you're thinking from a multi-asset perspective, it depends, again, what your risk-return profile is or your return expectations, but certainly we still like equities. I think given our growth view and our earnings expectation view and given where spreads are, fixed income absolutely has a role in a portfolio. But the reason I ask is we still certainly see upside to equities from here.
Yeah, you're not alone in that bullish take. Alexander Wolf from JPMorgan Private Bank. Up next, the auction block. Oracle credit risk rises alongside the slide of its stock. We'll discuss the state of credit as fears grow around the financing of the AI data center boom. This is Real Yield on Bloomberg. I'm Matt Miller. This is Bloomberg Real Yield. Time now for the auction block, where we highlight the debt sales of the week. And we start with sovereigns and U.S. Treasury auctions. We had 3, 10, and 30-year sales this week. All three came in with expected yields and saw demand near recent averages. Over in U.S. high grade, after a hot start to the month, sales cooled a bit this week with only $4.7 billion sold. December's issuance is now about a quarter below that for all of December of 2024, but still above average. And the strong pace of sales in high yield was able to be maintained. We are now looking at a December bond sales of more than $20 billion for only the second time in 6 years, making this the busiest December since 2020. Sticking with credit when it comes to hyperscalers like Oracle, Victor Koshla, the founder of Strategic Value Partners, says there will be more pressure on spreads as these borrowers finance the rollout of AI, while Oaktree co-chair Howard Marks still sees a healthy market.
Spreads can blow out to 600, 800, 900 over. And that's sort of what happens when in a recession. I don't think we're in a recession in the next year or two. Don't get the wrong idea.
Some of the greatest moments that I've seen, some of the greatest signals of danger in the markets have been when people were not applying any prudence at all, like in 2006. And this market seems healthier than the 2000 market.
The hyperscalers are coming to borrow in the high yield. The amount of supply is just going to increase a lot. I think, to our point of view, the pressure on spreads is likely to go up, barring a recession. And those spreads will have to kind of widen.
Joining us now for our credit roundtable, Amanda Lynam, head of macro credit research at BlackRock, and Maureen O'Connor, global head of high-grade debt syndicate, Wells Fargo corporate and investment banks. Welcome. Thanks so much for joining us. Let's start with issuance, Maureen, because there's been a lot, and I guess we should expect even more if these Capex plans are to be financed. How do you expect this to turn out?
You're absolutely right. We had a huge year already this year, just under $1.7 trillion in investment grade supply, and we are anticipating about 10 to 15% year-over-year growth next year. Will be a record year for primary volumes in 2026, somewhere in around 1.85, 1.9 trillion of supply. Biggest drivers behind that, actually, the biggest one is the probably the one that people don't want to talk about. It's just that we have elevated maturities. We have $900 billion in maturities coming due in 2026 that will just need to be refinanced. So that's going to be a tailwind for issuance. On top of that, we are expecting a tailwind in M&A supply as well, something like 25% year-over-year growth in terms of debt-financed M&A. Pretty healthy pipeline, obviously, in the last couple of weeks in particular. But clearly, it's all about Capex expansion right now, and what do the hyperscalers do in terms of unsecured debt financing next year. Tech supply this year was up 70% year-over-year. We're expecting that number to nearly double next year. So there will be some large benchmark supply coming through our market. But I think that the balance here is that most of these names are amongst our highest quality credits, right? These are low net debt, highly cash flow generative companies, AA rated for the most part. They have a lot of room to expand their debt footprint in our market before we really meet a saturation point. So I think there'll be some interesting sector dispersions next year, but our market can absorb the supply and is well set up to do so.
Yeah, I don't think there's a problem with multi-trillion-dollar companies issuing a couple tens of billions of dollars of debt, right? And on the demand side, there's cash that needs to be put to work, right? I mean, there's
absolutely
that's going to keep spreads tight.
Absolutely, and what we've seen, the experience from 2025 and even going back to 2024, is that periods of spread widening ultimately have proved short-lived. And so really what we expect for 2026 is a pretty constructive backdrop. It's going to be full of dispersion across sectors, even within sectors, across parts of the asset class, but we're not anticipating widespread market disruption. And I think probably the one thing that will tweak on the margin for 2026 is that we're really leaning in more to this idea that if you're allocating to credit, you should be allocating for carry and income and yield, not because there's room for spreads to move tighter because they're already quite tight, and actually not because we think intermediate or long end interest rates are going that much lower. So don't rely on that potential total return boost from tighter spreads or lower rates, but still have a compelling yield opportunity in corporate credit.
Can I just ask in terms of issuance, I'm not, yield is not my day job, right? I'm an equities guy, so I'm not as smart as the two of you. But when I hear something like the Fed is going to start buying $40 billion a month worth of bills, I start thinking, where's the line between, managing reserves and quantitative easing? Is that going to stay on that trade? How does it look? How does the Federal Reserve balance sheet look to you? And how much do we need to be issuing?
Well, I mean, I think the Federal Reserve is going to continue to support short-term funding, right? And that's, I think they delivered on a promise that they probably were maybe a little bit late on at this most recent Fed meeting. I think the bigger question is, what does the shape of the curve look like next year if the Fed is continuing to support short-term rates, if we potentially see a more politicized Fed and more cuts next year than what the market's anticipating, and long-end yields do remain elevated, which is indeed our call as well. What does that do to the overall landscape for just risk appetite more broadly as the curve gets steeper? For now, it's been a strong demand technical in my market. As Amanda rightly points out, the yield buyer is the predominant buyer of credit right now. We did actually have a healthy total return year, about 7% for the asset class, which in IG terms is a pretty big number. But in the end of the day, yields are still, screening very attractive from a historical perspective, even though spread valuations are quite rich. So we agree with the thesis that spreads are likely to remain somewhat range-bound, maybe even pressure a little bit wider based on some of the supply dynamics we discussed, but that the yield buyer will keep a lid on how much wider spreads can really go next year.
So from a strategy perspective, or from the Fed's perspective, sure, even, if that's the case, if the curve gets steeper, and I don't know if you agree with Maureen.
We do. Yeah, we do.
If yields at the longer end are going to remain high, even though the Fed is cutting lower, what are they helping?
Well, I think first and foremost, I think what we're most focused on is what are the depths and the drivers of this Fed rate cutting cycle if it persists into 2026. For most of 2025, we've been of the view that the Fed is really in a normalization cycle, not an easing cycle. So I think that's first and foremost, that maybe there's one more cut left in 2026 if the labor market stabilizes. And I think that's much more important, I think, from our view, because that will determine whether risk premia gets added back to credit markets. If the Fed is cutting because the labor market has shown real signs of deterioration, and we'll look to the data on Tuesday for that, then you should expect wider spreads and lower equities. I think getting back to your point, Matt, a steeper yield curve is in some ways a normalization, right? We were in this flat yield curve environment for a long period of time. And I think incremental relief for floating rate borrowers has had an impact on the market. The Fed's delivered 175 basis points of cuts. As a result, we've seen interest coverage and fixed charge coverage in the private credit market improve for 6 consecutive quarters. You've seen similar improvement in the leveraged loan market. There are vast cohorts of the consumer base, especially lower income with floating rate debt, that will benefit from that. So I think, it's parsing the different areas of the economy and recognizing that they can't all be serviced with the blunt instrument of Fed rate cuts. But for sure, there are nuances on the credit spectrum. But I think from a broader perspective, an elevated yield backdrop, so long as it doesn't become disorderly, has actually been a net tailwind for credit demand.
By the way, Maureen, will we see issuance from companies that see CDS, what looks like big jumps, even if they're still low absolute numbers?
Well, so I think you have to kind of bifurcate the two markets. The CDS market can be driven by a number of different factors, including how banks hedge their risk. These obviously were big capital providers to a lot of the names that you're probably alluding to there. The answer is yes, there is still access. Our market is quite efficient at pricing risk and supply overhang. I would equate it back to when you saw the big six U.S. banks during the TLAC expansion years, that kind of 2016 to 2019 cycle where you saw the debt footprints of these big U.S. GSIB banks expand pretty dramatically. The net result of that was that spreads trended wider in those names relative to the index. But, these companies still efficiently fund in our market on a quarterly basis post earnings. And we would expect the same for a lot of these technology companies where you're seeing a little bit of noise in the CDS. Obviously, there are some names that have fared better than others. But for the most part, again, these are high quality credits with unfettered access to our market. And it doesn't all have to come in dollars either, right? You've seen some cross currency transactions. I would expect to see more of that as well next year. But, there's other capital market solutions as well, ABS, CMBS. Bank solutions, other private credit solutions, including some of these sponsor-backed structures. So I think it's going to take all forms next year, not necessarily just about unsecured bond issuance.
Amanda, I work with Danny Berger. She talks with all the private markets people, right? So there's a lot of cockroach conversations. Just 10 seconds. Are you concerned at all about private credit?
No, we're not. I would say aggregate fundamentals look pretty solid, but just like liquid credit, there's a significant amount of dispersion under the surface, and we expect that trend to be evident next year.
All right, excellent. Thanks so much to both of you for joining us. Amanda Lynam of BlackRock and Maureen O'Connor of Wells Fargo. Still ahead, the final spread, the week ahead, a massive global data dump heading into the final full trading week of the year. This is Real Yield on Bloomberg. I'm Matt Miller. This is Bloomberg Real Yield. Time now for the final spread, the week ahead. Coming up Monday, Fed speak from Myron and Williams. Plus, we'll get a host of economic data out of China. Tuesday, the much anticipated November U.S. jobs report, a bit delayed. Plus, retail sales and the UK jobs report. Wednesday, a slew of data out of Europe. Japanese trade figures plus earnings from Micron and General Mills. Thursday, U.S. CPI and jobless claims, rate decisions from the BOE and ECB, and earnings from Nike and FedEx. And then Friday, Putin's year-end news conference and a Bank of Japan rate decision from New York. That does it. From us, same time, same place next week.